It is often crucial to consider taxes when making investment decisions. But should it be the primary focus? Tax planning is important, but investment decisions shouldn't be driven solely by taxes. Prioritizing tax considerations can lead to suboptimal allocations. Young earners might rush into tax saving schemes without aligning with their financial goals, while seasoned investors might chase tax loopholes. Focusing too much on tax breaks can cause tunnel vision, overlooking key aspects like aligning investments with financial goals, matching asset allocation to risk profile, and ensuring safety and liquidity. Let us discuss common mistakes investors make when they overly focus on avoiding taxes. Welcome to holisticinvestment.in. Home loan trap. Buying a home is a significant decision with lasting financial impacts. In India, tax benefit under Section 80C and under Section 24B of Income Tax Act make home. Focusing on deductions can cause you to overlook the true cost of ownership, market condition, and your financial readiness. Prioritize financial stability and ensure the home aligns with your long-term goals before considering tax benefits. Young earners and home loans. Young professionals often take large home loans with long EMIs to save on taxes, but this can be a trap. Committing significant income to lenders limits financial flexibility and increases stress. Before taking on a big home loan, consider if the tax benefit outweighs the long-term financial burden and if there are better ways to use your income to build wealth. Buying a home early in your career. Buying a home loan early in your career in India can limit mobility and career opportunities. Long EMIs in your 20s or 30s impact your ability to save or invest during prime earning years. Before rushing into home ownership, consider if it sacrifices your financial flexibility and investment opportunities during critical years. Sacrificing liquidity and flexibility for tax breaks. Young individuals often tie themselves to home loans for tax benefit, but seasoned investors can also fall into trap committing to products with hefty annual payouts or long-term commitments. Consider guaranteed income plans from insurers requiring premiums for 8 to 13 years in exchange for later income. Although attractive, these plans often have a low internal rate of return, IRR of around 5.5% to 6.5%, with the main draw being tax-free returns. Despite recent budget changes taxing maturity proceeds on plans with premium over rupees 5 lakhs annually, plans with lower premium still offer tax benefits. Committing to low return endowment plans or ULIPs which penalize exit within 5 years can be equally problematic. Before jumping into such products for tax breaks, consider the long-term implication and ensure you are not sacrificing liquidity and flexibility for short-term gains. The tax trap. Holding stocks for long-term capital gain benefits. Imagine this scenario. You have invested in a stock that has surged by 40% in just 8 months, exceeding your target return of 30%. Now, you are torn between booking profits and holding on for another 4 months to benefit from long-term capital gains tax advantage. It's a common dilemma, but let's reconsider. Is your decision driven solely by tax concerns? Holding on for long-term capital gain benefit might seem smart for enhancing post-tax returns. However, remember the fundamental rule of investing. If something seems too good to be true, it probably is. The stock has surpassed your annual target return in just 8 months. Even if you book short-term capital gain and pay the 15% tax, your post-tax still be 34%, more than your initial target. If you have strong conviction in the stock's fundamental, holding on might be justified. However, holding a stock solely for tax benefit isn't prudent. 4 months is a significant time in the stock market. Prices can fluctuate and your profits could vanish. Before letting tax concerns dictate your investment decisions, weigh the risk and reward carefully. The goal is to maximize return while minimizing risk, not to chase tax benefit at the expense of potential gains. Unnecessary portfolio churn, a risky game. The government frequently adjusts income and capital gains tax rates, finding new ways to tax investment returns. In response, some investors constantly reshuffle their portfolio to exploit these changing tax laws. Consider the 2023 budget move that eliminated indexation benefit and capital gains taxation on debt mutual funds. This change prompted many investors to switch from debt funds to equity savings or hybrid funds. But are these moves always wise? Equity based funds may offer higher returns but come with increased risk. And future tax changes are unpredictable. If the finance minister closed the loophole for indexation benefit on hybrid funds, investors could be back at square one. Constant portfolio churn to capitalize on minor tax changes can disrupt the compounding effect, which is crucial in investing. For example, investors who sell their equity holdings annually to use the 1 lakh per year capital gains tax exemption may not find the tax savings worth the transaction cost and the risk of re-entering the market at higher prices. Before engaging in portfolio churn for tax benefits, consider the bigger picture. Are you geoparadising long-term investment goals for short-term tax gains? Successful investing requires patience, discipline, and a long-term perspective, not chasing every tax loophole. Beware of fragmented holdings. Some investors try to outsmart tax authorities by spreading their investments across various accounts, platforms, and identities. In the past, this might have worked out due to limited tracking capabilities. However, with the advent of PAN, Aadhaar linkages, and advanced data mining, today's Indian tax authorities can precisely track high-value transactions and bank deposits. Fragmented holdings add complexity to your financial life and offer little protection from taxes. Moreover, this approach can create significant challenges for your legal hires when settling your affairs. Before resorting to such tactics, ask yourself, is potential tax evasion worth the risk and hassle? Prioritize simplicity and transparency in your financial affairs to avoid unnecessary complications. Beware of product goal mismatches. Aligning your investment with the time horizon of your financial goals is fundamental. No reputable advisor would recommend using equities for regular income or debt for long-term wealth creation. However, in the quest to save on taxes, many investors fall into this trap. For example, those with hefty retirement goals often rely heavily on tax-free investments like EPF and PPF, allocating only a fraction to equities. While EPF and PPF are tax-free, they offer lower returns compared to equities. Paying a 10% capital gains tax on assets compounding at 12 to 13% could yield higher return than settling for a tax-free 7 to 8%. This mismatch isn't limited to retirement planning. Investors with child education goals, for example, could benefit from higher returns of aggressive or balanced equity funds. However, many opt for Sukanya Samriddhi scheme for its tax-free status, despite its constraints and fluctuating returns. Before letting tax considerations dictate your investment choices, ask yourself, are you sacrificing long-term growth for short-term tax benefits? Prioritize your financial goals over tax advantages to ensure you are on the right path to financial security. Do not let taxes dictate your investment choices. Finding great investments is challenging and requires perseverance. While tax consequences are important, they shouldn't drive your decisions. The government's shift toward a new tax regime free of exemptions underscores the need to focus on your financial goals rather than react to tax changes. Investing to save tax? Then consider the following consequences. Asset allocation compromises. Focusing on tax-saving instrument can lead to poor asset allocation, hindering long-term growth. Operational flexibility sacrifices. Tax-saving products with a lock-in feature limit your financial flexibility and adaptability. Accessing assets for important needs. Investing solely to save tax can restrict access to assets when needed for significant financial purposes. Complicated bequests. Tax-focused investment can complicate asset management and bequest, especially for legal hires abroad. A thoughtful approach. Reassess your investments to ensure they align with your financial goals, not just tax benefits. Prioritize careful management for long-term success. A detailed blog post on this topic is available in our website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.